Good afternoon, everyone, and thank you for joining our second Compensation Committee webinar of 2024. My name is Mary Canizales. I'm the Senior Manager in Corporate Partnerships over at NACD, and I'd like to welcome you to this second webinar in our series along with our partner, Pearl Meyer. Today's webcast will focus on the proper role of peer group data in compensation decision-making, what you should consider when structuring a peer group, and how to maximize the impact of peer group information. Our panelists, Greg Stokel and Kim Neal, will cover typical and atypical approaches to compensation peer groups and the types of analysis and data that can be used by compensation committees to inform your decision-making. But before we get into the specifics, I'd love to cover some housekeeping items. We'd love to hear from you, so please submit your questions by adding them into the Q&A section of the webinar portal. We've built in a little bit of time in the Q&A for Q&A in the end. If we don't, for some reason, get to your question, don't worry. We're going to capture your email and we're going to send it over to our friends at Pearl Meyer so that they can respond directly to you within the next couple of days. The number one question we always get is if the webinar and the slides will be available afterwards. As always, the recording of this webinar will be available early next week on both NACD and Pearl Meyer websites. You can also access the presentation slides and some really great thought leadership that Pearl Meyer's put together in our additional resources section and also in the post-webinar emails. For our certified directors and board director fellows, your participation in today's live webinar earns you credit towards maintaining NACD credentials. So you will automatically receive 1 credit for your participation, but please note that you must attend the webinar for at least 50 minutes to receive that credit. Speaking of our NACD Director Certification Program, if you're interested in learning more about setting yourself apart as a high-performance director, this is a really great designation to do so. Check out the webpage or contact your membership advisor at credentialing@nacdonline.org. Finally, we'll have a few evaluation questions and a follow-up email to this program, and it's also in your attendee hub. We'd really appreciate your feedback because we're always looking to improve our webinars, and your insight gives us that information about how we can make our webinars better. So with that, let's get to the meat and potatoes. I'd like to pass it over to our experts. Greg, why don't you go ahead and get us started?
Mary, thank you so much. We're so excited to be here with you this afternoon. As Mary said, I'm Greg Stokel from Pearl Meyer. I'm here with my colleague, Kim Neal. We're going to lead you through today's discussion. And Mary said it well. We're going to talk about not only how to build a peer group, but really how to use a peer group effectively to support executive compensation decision-making. If you look at our agenda here that's up, we've really organized our discussion today into 4 main areas. The first thing we're going to talk about is just the role of peer groups in executive compensation so that we can make sure we're laser focused on the topic that we want to focus on today. The second and third are, again, what I mentioned about building a peer group. There's 2 really different angles to think about. One is how do you select individual companies for consideration into a peer group? And then the second is really how do you assess the resulting peer group overall? So we're going to spend a good amount of time on items 2 and items 3, the individual selection of peer companies, and then the assessment of the aggregate group. And then the final thing in section 4 of today's discussion, we will talk about both the sort of traditional and non-traditional peer group analyses. So what are some of the things you should be getting out of your peer group in terms of data and information to support executive compensation decisions? So that's the overall structure for today's discussion. I'm going to turn it over to Kim for agenda item number 1.
All right, so on the next page, we're going to get started and really dive in to the role of the peer group. So in executive compensation, there really are a variety of different peer groups now, and each with a different purpose. So on this page, what we've done is highlighted 3 common peer groups, and we've actually selected names to make it nice and clear so you understand the purpose each one serves. The first one here, which we've highlighted, is that benchmarking peer group. This is the focus of today's discussion. It's commonly used to provide market context around executive pay levels, plan designs, and other pay practices. There are also 2 other sorts of groups. The second one is a performance peer group, and it is just that. It's used to measure your relative performance against that set. This might be a peer group used for an incentive program, say a PSU program to measure relative TSR. It might be a hand-selected peer group that you're using in the new pay versus performance disclosure, where you've got your table of pay information, and you're then comparing your TSR against the peer group. And the last one here we've listed is that aspirational peer group. This is generally, a group of companies that you aspire to be like. They may be larger in size, whether it be revenue or assets. They might be high performing. But the idea behind this peer group is to get a sense of what their pay levels and pay practices are, so you can understand where you are now and how that compares to your aspirational group. How does size or high performance impact those plan designs? So that's just a little bit of background on the role of peer groups. Again, we're going to focus on the benchmarking peer group today. But I think to get us started, before we dive into that, we would really probably like to get a sense of where everyone stands and what sort of executive compensation peer groups you all use today. So with that, we're going to launch the first poll question just to get a sense of where everyone is in our audience today. So it just popped up. Which types of peer groups do you use in executive compensation? We have that benchmarking peer group only, benchmarking and performance peer groups, all three. That includes the aspirational peer group, that third one, or D, none. We don't use peer groups. I think I have an idea of where we'll fall here, but it'll be interesting to see the results pull through.
The aspirational peers, Kim, I think is so interesting to say, as you pointed out, is there a subset of larger companies that we should be looking at because our people might get picked to run larger companies, or to your point, higher performing companies. And these don't work their way into proxy disclosures normally. They're just additional reference points, that you can look at and say, well, the data would be 8, 10, 12% higher if we looked at companies that were significantly larger than us. So it is a useful additional reference point.
Absolutely. Now, do you see anything in terms of trends by industry or company size? I tend to see sometimes the smaller companies really do just focus around executive benchmarking peer groups. And maybe some of those larger companies will introduce the performance peer groups because they start to have those complex incentive designs, those PSU programs. Do you see anything different, Greg?
No, I think that's exactly right. And, again, some companies are a little concerned, I think, that if we use a different group of companies, we might have to disclose it. But I think there's a way to use it in the process that you wouldn't have to be forced to disclose it in the proxy.
Absolutely. And with that, it looks like we closed the results. And I am not too surprised by this, Greg. So 51%, a little over half, just use that benchmarking peer group. 31% use benchmarking and performance peer groups. Only 10% use all three, but I'll be honest, that's a little higher than I was expecting. So that's interesting. And then 8%, we don't use peer groups. So I think based on these results, we're very timely and on topic with this discussion. I think with that, we can go ahead and let's move forward onto the next slide. Perfect. So here, what we're trying to get at is the objective of that benchmarking peer group. And it really is to get a group of companies that are competitors. That'll be for talent, capital, and business. We really prioritize those companies that compete for talent because, as it suggests, we're trying to understand competitive pay levels for those companies. But we can't, restrict ourselves to just direct competitors. We have to extend beyond. So here we encourage you to consider other companies within the same industry, even if they aren't direct competitors. This helps you really build out that group and understand not just your specific competitors, but really what those market trends and practices are that impact you. And with that, Greg, I think we can go ahead and probably just dive into the peer group process. How do we identify some of these companies?
Perfect. Thanks, Kim. Yeah, if we move on, again, we're going to start with how do we come up with the list of companies that we want to select from to possibly include in our benchmarking peer group. And in a very traditional sense, you could start with all publicly traded companies, globally. You could narrow that down to publicly traded companies in the US. You could do a screen based on industry. Maybe it's a GICS code that you're using, and then you could further filter that by size and some other criteria. What we're suggesting here is that another way to go about it that might be a little more focused is to really start looking at the types of companies, for example, that your competitors are using as peers. So if you've got 3, 4, 5, maybe it's just 2 direct industry competitors that are publicly traded, you obviously can go to their proxies and see which kinds of companies or the list of companies that they disclose in their CDNA and use as peers. So step one, again, might be to look at your publicly traded competitors and who they're using as peers, just to get that initial sense. Second thing you could do is what we call reverse peers, which is what public companies out there use your company as a peer in their peer group. And I think this can be a fascinating view. Sometimes it's shocking, really, to see who out there uses your company as a benchmarking peer. So not that you have to follow their lead and go ahead and reciprocate, but I do think it gives you some interesting insight, again, when companies are using you as a peer group for their benchmarking. Third thing you could look at, we might get some grimacing here from directors, is we could look at the ISS and the Glass Lewis peer groups. So it's it's hit or miss, really, on the ISS and Glass Lewis peer group. Sometimes there's some useful companies in there and sometimes they're not. As most of you are aware, their methodologies are a little more focused on just industry and revenue size. And sometimes that creates a somewhat strange, list of companies that make it into their list. For example, we had a global manufacturing company that we've been working with very recently. And for whatever reason, ISS and their peer group had a bunch of home builders that worked their way into the peer group, which in our opinion was a very different business. But again, nonetheless, having some degree of overlap with the peer group that your compensation committee is using to make pay decisions, and then the peer group that the proxy advisory firms are using on their end to assess those decisions, having some symmetry there makes some sense. And then the third thing that you could think about in terms of an available list of companies would be to look at the valuation peers. That would be maybe looking at investor relations and saying, hey, if we ever had some investment bankers in here, what types of companies would they look at to think about us as peers? We put an asterisk on that one only because when you're thinking about valuation or investment banking peers, there's really no size restriction. Any size company will work if you're just looking at how are they valued relative to EBITDA or revenue. But for our purposes in executive compensation benchmarking, we do have to be more sensitive to size characteristics. So again, the traditional approach starts with the big funnel and industry and size. This would say, hey, let's get a list of companies to start with by looking at our competitors' peer groups, our reverse peers, who ISS and Glass Lewis include, and potentially some valuation peers. Kim, anything different you would think about there?
I think that covers it. What I like to look at is kind of how we go across all of these, and are there any overlaps across these buckets where there's 1 or 2 companies that continuously recur that maybe we should consider seriously or put toward the high or the top end of our selection.
Perfect. So if we move on, what we want to do, so that gives you some initial lists. And then the real question is, once we look at all of these different companies, again, whether we go the traditional kind of big funnel approach or we start by generating these lists in the way that we just described, how do we start to whittle down, that list into the companies that are most likely to make it into our list as potential peers? And we do think there's a pecking order here to think about. I'd say we normally start with what I mentioned as, industry and size being critical for an executive compensation benchmarking peer group. And the industry doesn't have to be exactly the same, but it should have some similar characteristics in terms of economic factors that impact it, the customer base that you're going after, the operating model in the industry. So industry is certainly an important criteria. that we need to be focused on. But for example, we work with some restaurant companies that include retailers in their peer group. We work with some retailers that include restaurant operators. Those are viewed as similar enough in terms of the footprint and some of the issues that they're dealing with to be comparable. We're going to talk a lot about size really on the next page, so we'll hold off on that. But it is important to make sure that the companies we're using to benchmarking pay are of a similar size to our business. I would say the next set of criteria that we really focus on is complexity and business model. And these are also, in our judgment, very important considerations. Let me give you some examples. So complexity might be, we're a multi-business unit, business. So we're not just managing one business, we're managing maybe 3 segments or 3 divisions. That certainly adds complexity to those leadership roles: CEO, CFO, COO, general counsel, HR, etc. Complexity could also be driven by whether you're a predominantly US-based business or whether you have significant global operations, right? So now we have to worry about all the different countries in which we operate around the world and exchange rates, etc. So complexity and building in some of these variables into how you think about narrowing the list of companies that you might consider to be peers is an important dimension to think about. Business model, I think a clear example here in the restaurant space, there's lots of companies that are franchise businesses, meaning they don't own their restaurants, but they open them up to franchisees to run the restaurant. So a restaurant with a highly franchised business model is very different than a restaurant that doesn't have a franchised business model. And there's plenty other examples like that. So again, just taking a look at how they go to market, how their business is organized. Are they completely vertically integrated? Are they not? I mean, there's lots of things that could end up in that bucket of business model. So you start with industry and size, you consider complexity and business model. And I think the final things to really think about, if you're lucky enough to have an abundance of choices and you need some more variables to look at to screen, you could start looking at life cycle stage and even performance. Life cycle stage would be, right, are we more of a startup? Are we mature? Are we in turnaround mode? Those, again, would be things, I think, on the edges that you would think about in terms of whittling down the group after having gone through some of the more significant factors that we mentioned. And then performance, again, I don't think you need to focus on it, but you might look at a group and say, well, if I have to choose between company A and company B, why not go with the company that's a little bit higher performer or has positive total shareholder returns over the recent time period, as opposed to the company that might be hurting in terms of profitability or total shareholder return. So again, lots of things to think about to narrow the list of companies that might make it into your final list of peers. Kim, any other thoughts you have there?
I think that's great. And just to kind of paint a visual here, you literally in front of you have a list of all potential peers. So having these additional criteria on top of what Greg will get into size-wise, it's helpful to have a strong rationale and have a methodical approach on how you actually get to this peer group of companies.
Yeah, I think too, it's nice if you think about it from a proxy disclosure standpoint. It gives you even a little more reason or rationale for how you ended up with the peer group that you have. Because if you go through a diligent process like this, certainly you could weave some of this considerations and criteria, directly into the CDNA in terms of the factors that you used to develop your peer group. If we turn to the next page, I said we would focus on size. This is really important for a benchmarking peer group, and sometimes if the process is driven more by investor relations, this is the piece that gets a little bit lost in the shuffle, which is because we're using it to compare our pay levels against these other companies, we really do need to be sensitive to the size of the companies that we're including. And we look at a variety of metrics. You usually have to triangulate it. There's no one perfect measure. We've highlighted revenue as being sort of the most important size parameter for companies outside the financial services industry. If it's in the financial services industry, if you're in banking, for example, then asset size would kind of be your critical factor. But for companies outside of financial services, I think revenue is sort of the key variable of size to consider. And there's a lot of reasons for that. One is the empirical evidence suggests that executive compensation levels is the most highly correlated with revenue size of the business. The second is, for those of you that use peer group benchmarking and survey benchmarking, you'll know that really the only way to size the survey data is on revenue. So we end up with some parity between the peer group data that we're looking at and potentially the survey data that we're looking at as well when we focus on revenue. And there's all kinds of views on what's the acceptable range. We tend to say, hey, if we can find enough companies that are between half our size and twice our size, that's probably reasonable. And we point out that sometimes you have to expand that range in order to get a sufficient number of companies into the group. But when I think about size, again, revenue being the most important, but then I would sort of skip the next two for a minute and I start to think about enterprise value and to a lesser extent number of employees. But enterprise value is a good measure of sort of the overall size of the business from an investor perspective, because enterprise value includes, of course, shareholder equity as well as debt. So all of the potential investors, whether they're debt holders or shareholders on the business, and number of employees. Again, it might be more indicative of business model. Do we own a lot of our employees? Do we use part-time? But it can be, again, important for sizing the business. I look at EBITDA and market cap, the second and third on this list, a little differently, which might help us get a better understanding of what we refer to as sort of ability to pay. And so EBITDA, to make sure that our level of profitability is somewhat comparable to the group of companies that we're going to compare ourselves to, seems to make perfect sense, right? So in addition to revenue, enterprise value, number of employees, let's make sure that our EBITDA that we're producing is, somewhat comparable to our peers. And market cap is also important. Some people would say, well, if we're using enterprise value, do we really need market cap? And the reason I think market cap is an important consideration is because so much of executive compensation is equity-based. And it's the market cap of the company that is really, when we talk about equity-based compensation, that matters. So if you're a billion-dollar market cap company and you're comparing yourselves to $10 billion market cap companies, it's going to take you 10 times as many shares to match them dollar for dollar on equity-based compensation in some cases. So when you start to, again, think about comparability, I think surrounding it, and when we say size, to look at all of these measures, and you're never going to find a peer group where you're right at the middle on all of these. It's always going to require some trade-offs. And again, we'd say focus on revenue, be concerned about EBITDA and market cap, and then look maybe a little bit more broadly to enterprise value and number of employees if you have to make some final decisions. Anything else you'd say there, Kim?
I think it's all interesting. Now, one question for you, when it comes down to all of these criteria, if you were to, aside from revenue, select one other key metric, if we're really trying to get to the 50th percentile in revenue, which one would you select? Is it enterprise value? Is it EBITDA? Does it change by industry?
Yeah, I'd probably go market cap, believe it or not, for what I just mentioned. I just feel like this is where some companies miss the mark a little bit and they end up with a grant rate that's much higher than everybody else. And so being responsive to the fact that, we can't, benchmark ourselves against companies that are so much more valuable than us in terms of equity value, and then try to match them dollar for dollar on equity grant value.
And that really transcends industry.
It does. So I think this brings up our second polling question, if I'm not mistaken. So
yes.
We're taking you through, again, some of the things to consider around criteria. And so, again, similar structure to the last polling question, which is, how do you think about how you've looked at peer groups in your organization? Do you think you've used most of the criteria, the factors that we've mentioned? Do you think you've used some of them, but not all? Would you say maybe we've used none of them, but we should? Or maybe you're in the camp of, none of them, and that's just fine with us, that either we don't have a peer group, back to the previous polling question, or we've got a completely different set of criteria for our business. So take a minute and tell us what you think in terms of the criteria that you use for building your peer group.
Now, Greg,
I'm expecting some. I
was just going to jump in here. I think the popular one is going to be some. I tend to see a lot of focus on revenue. And of course, in discussions, we'll pull some of these other criteria in, but not necessarily in kind of a prescriptive range as we've laid out. So we might see some differences here. Where do you think everyone's going to land, Greg?
Yeah, I think B will be a big one. I'd be surprised if we get a high percentage of A's, but oh, here we go. All right. So look, we were prophetic, I guess, right? We've got, is it 63% of our gang here today is saying we use some but not all, but almost a third are using most of the criteria and factors we mentioned, which is fantastic.
That is. And the great news is it's not too late to layer one or more of these in. So we can certainly start to consider more of the criteria as well as you're working through peer groups in the future.
Fantastic. Perfect. Thank you all for responding. Kim, I'll turn it back to you.
All right, let's get on to the next page. So Greg had framed up this as kind of a two-step process. So when you're developing your peer group, first step is to identify which companies. Second step is to really assess the group overall. So you've identified the individuals. So now let's see how they work as a group. On this page, we've kind of broken down some different areas to consider when you're reviewing all companies together. So the first item here is sample size. And of course, this links directly to the quality of the data. You want to make sure you have a sufficient number of companies to inform your data, right? But you don't simply want to just add companies to have more. Too many companies, you might be reaching just to increase that number, and that can lead to diminishing returns. So we want to be cognizant about the number of companies we have. And we say 10 to 20. Could be 22, could be 23, could be 25. But you understand that range, so we have sufficient data. Now, the second item is company positioning. And this is where I think it takes quite a bit of finesse sometimes. So across the majority of metrics, ideally you're near the 50th percentile. And we call the 50th percentile out here because this generally links to pay philosophy. If you are paying around the 50th percentile, having those size metrics, those key metrics around the 50th percentile goes hand in hand. And of course, kind of as Greg had just mentioned, revenue being the most important, followed by his market cap. We've highlighted both of those here to keep an eye on. Now, 50th percentile, it could be 40th, it could be 55th, but that's the idea here, is to get into the ballpark. This middle one here, dispersion. This is a newer concept, and Greg is a large fan of it, and we've pulled it into a lot of what we've done, and I think it's been quite enlightening. So dispersion is really what the range is between your lowest and highest. So if you were to take revenues, you might have a large dispersion, meaning you've got some peers that are low revenue, some that are very high revenue. Ideally, you want to tighten that dispersion and keep it within that, appropriate range. That way you get more solid data, you get more reliable data. Again, getting back to that quality of the inputs. So ideally your dispersion is limited here. ISS and Glass-Lewis overlap. This is, I'm going to call it out, it is a nice to have, it's not a need to have. So when you're looking at those individual peers to pull together your group, of course, keep track and keep an eye on how many peers overlap with ISS and Glass-Lewis. It is nice to have a decent amount of overlap. That kind of gives you insight into some of those tests they might run, some of those companies they're comparing your pay practices to, but it is not essential. And then, of course, looking at industry and complexity based on your company. What sort of peers? Is there a majority that have a complex footprint? Are the majority also, have revenues that are non-US? Do the majority have multiple brands? So it's just understanding holistically, how does the group look and how does that compare to you?
I would say on the dispersion, again, there used to be this, headline grabbing notation or something that would say, man drowns in lake of average depth 1 inch, and you're like, well, how could that possibly be? And you're like, well, in that case, the average doesn't really tell you much about the true nature of the lake in that case that we're talking about. And when you have a peer group that has really large dispersion, meaning we've got companies that are 15 times our size and we've got companies that are, 1/10 our size, the resulting pay data can also be so varied that looking at the median is a little less significant, or the average, than if we had a group of companies that were tighter together. It also results in the spread between the 25th and 75th percentile on the pay data, in some cases being very wide. And so you've got a lot more latitude in how you're managing compensation if we end up with a peer group that has, again, a high degree of dispersion on some of these critical size metrics.
Yeah, so it really is an art balancing company position around the 50th, but also keeping in mind those lows and highs across the metrics.
The other thing I could just tell you that I think can be frustrating sometimes is that, again, if you're one of these companies that has the luxury of, there are 30 individual companies that all seem to pass your criteria, and you're trying to get down to the 20 or the 15 that you want to use. I mean, again, it's a luxurious position to be in, but as Kim mentioned, the art of picking those 15 or 20 based on the impact on the aggregate result. So it may not be the 15 or 20 that you think are truly the best. It's the 15 or 20 that when you put them together, they're the best in terms of the resulting either dispersion or where the median of that group of companies is, even if you had to sacrifice individual companies that might have been, for example, a better industry fit or a better business model fit to get to that result that you're looking for.
That's a great point, Greg. That really hits home the idea of you've got to look at this as a group and overall how they compare to you. Now, on the next page, I think we've got a nice illustration of, so what do we do with all this information? We've got, we went through the process of pulling together our list. We have all these criteria we need to look at in terms of size. We need to look at the peer group all together. So how do we actually do this? So we recommend just start with your list of peers. And right here, we've got kind of a current peer group for our example company. And we've included across all those key fields. So we've got revenue, EBITDA, market cap, all those standard items to look at. We also, all the way to the right-hand side there, we've got ISS Glass Lewis, so peer overlap as well. So we've got everything here. There's a lot of numbers. So somehow we need to be able to summarize, to be able to then analyze what does this group look like. So we've got a set of summary statistics, that percentile summary there. This shows us the 25th, 50th, 75th percentile and dispersion, what Greg was just talking about, so that range across the metrics. This gives us a quick glance into how the group looks overall. Now, somehow we have to compare ourselves to this group. How do we stack up? So there's two considerations here we've laid out. One is percentile rank, and I think that's the most standard approach. So you're going to stack rank essentially all these companies and identify where you fall in that rank. This can be challenging sometimes, and we run into this every now and again, where the data is very compressed. You might be showing at the 25th percentile, but you're really not that far off from median. It just happens to be the compression of data. So one way to kind of combat that and show some sort of comparison is to use a percent of median. And that's what we've got here. So although you might be at the 25th percentile, you could be 90% of median, meaning you're within a reasonable range. And that percentile rank can be alarming, but it's not it at the end of the day. There's more to it. There's more context there. And then finally, just kind of thinking about how do we pull this all together? How do we digest this? I mean, all this information, all this data, creating some sort of an overall assessment is probably one of the most important things. So you can really see, what do we have here? What are we working with? Where are our weaknesses? Where are our strengths? So what we've done is in that box, just listed out some criteria. And I'll frame it up as there's a lot of criteria listed, and not each one, is not created equally. So one might be more important than the other, but we've laid it all out. So we've got a bunch of items to look at. You can see the first one is a sample size of 16. We mentioned, you want 10 to 20. So right here, we've got green, indicates criteria is satisfied. Next item, ISS overlap. Again, that's a nice to have. So I wouldn't treat this in an equal manner to the size of the peer group, the sample size. But in any case, we've got 5 of 16. It's yellow. We're okay there. And you'll see going across the board, we've got those different items to look at, and we've color coded it, the red, green, yellow. So it jumps off the page of areas where we're doing well, and then potential areas to improve. And those areas to improve will ideally help inform what kind of peers are we going to include? What kind of peers are we going to drop from our peer group? How are we going to evolve this group of companies so it's more comparable to us? And this is just an easy way to summarize all of that.
And I would just add this pattern that you see in the color-coded part of the chart, this led, Kim and I in this case to say, man, I wonder if there's a better peer group out there. There's a lot of red, there's a lot of yellow. Is there a way we can turn a few more of these green? And it did actually lead to some changes to their peer group. And most of those dispersion categories went to green. The percent foreign companies went to green because we decided to get rid of them. And honestly, what the trade-off was, the sample size went from green to yellow. So we ended up shrinking this peer group to try to improve a lot of the other dimensions, and I think we ended up with 12. And so we said, well, that's riskier to go from 16 to 12. So we made a negative change on that one dimension, but the trade-off was we made a positive change in a lot of the other variables that we were looking at that we thought were important.
Yeah, and it's nice to be able to literally just flip current state, proposed state, and see those colors change and see where those improvements were made. And again, some of these criteria are more important than others, so you can really hone in on those ones that are important. Now, if we get to the next slide, what we're going to go into, I kind of alluded to this just a few moments ago, is the process of updating the peer group. So if you recall that last example, we found some areas where there could be improvement. That kind of rolls into your process of updating peer groups. And it really is good hygiene to review your compensation peer group regularly. And well, what does that mean? Typically, that's annually. And you start with your current peer group. You want to review the criteria, those size ranges. Are those still appropriate? Have you grown? Have you shrunk? What areas of your business have changed? That way you can really identify the criteria that makes most sense for you in your current state. Do the current peers fit that? You can identify those that no longer fit your criteria and fall out. Have any fallen out due to M&A? Depending upon your industry, it might be a very active year. I know banking has struggled with this over the years, a lot of M&A activity. So those that have fallen out, you no longer have disclosures, you no longer have insight into their compensation programs, so naturally they will fall out of your group. You can also look at ISS and Glass Lewis and see if their perspective has changed. And if it has, is there anything new to consider? Again, it's a nice to have, not a need to have. So just understanding how their groups have evolved might help inform yours. And ideally, you're not going to have many changes year over year. Once you have a solid peer group, you've arrived at the peers in a methodical approach. They all fit from a size, industry, business model perspective. Ideally, year over year, you're only making a few changes when needed, not an actual overhaul. Unless, of course, something drastic has happened to the company, then, of course, you want to make sure the peer group and the structure is aligning with it. But ideally, once you put in all that work up front to establish the peer group, it's really maintenance year over year.
Totally agree with that. I would just say, avoiding the temptation to change for change's sake. So we do suggest looking at it every year, but that doesn't mean you change it every year. And to what Kim just said is really the most important point, I think, which is if nothing's really changed with our business, then there's probably no need to change the peer group unless we've lost a lot of companies to M&A or there's some new entrants with IPOs that we should really consider to make it stronger. But a no change year for a peer group should be celebrated, not feared.
Yeah, it's a great thing. And then it also helps with the data analysis. You have the same peer companies, maybe you have the same incumbents in certain positions. You can really analyze how those companies, how those specific executives, their pay packages are changing year over year. So that's an interesting detail that you can get. out of this review. Now, I think we're about ready for another poll question. And again, this is just to get a better understanding of where our audience is. So now, after going through this peer group kind of development and assessment process, how are you all feeling about your current peer groups? Is it aligned with most of the factors? Aligned with some of the factors? It is not aligned, but should be? Or it's just not aligned?
Yeah, it's interesting. So the first question that we posed in the same way was about individual companies, and this one is more about the resulting, aggregate peer group and how it looks relative to some of the criteria that we've just recently discussed.
Mm-hmm.
Two very different. They should be aligned. You would think you'd get a lot of B's here, but you just never know because, again, I think a lot of companies spend a lot of time on the individual companies, but maybe a little less time on does the resulting peer group as a group meet also the criteria that we're looking at in terms of overlap and dispersion and comparisons and all that.
Mm-hmm. And you mentioned this before. It might be a hard decision. You might not have all your exact direct competitors. You might have to go out a little bit to make sure that your peer group as a whole makes sense dispersion wise. You're near the median. You have decent overlap when appropriate. And it looks like the results came in, and Greg, you predicted it correctly. So we're falling in line with the prior results. So B, it is aligned with some of the factors mentioned, is the most popular at 56. Most comes up second at 32%. And then no alignment is kind of the remaining folks there. Surprised at all, Greg?
Well, I like the 9% that are like, wait a minute, it should be. Why isn't it? Did we not look at it this way? Or is there some, new content there that, perspectives that maybe they'll start looking at in terms
Exactly. And it might just be that fresh perspective, new look that changes things. Now, we've kind of gone through that whole creating the peer group process. So, Greg, I went through this whole process. It was painful. It was a lot of work. We had a lot of deliberation. So what can I do with my peer group now?
There you go. Perfect. On the next page, we're going to talk about the traditional things. And these are probably things that you're all familiar with. So I'll take a little bit less time on these so that we have enough time to really dig into the more interesting analyses that we can do. So let me just talk about each of these while we're on this page, because we only have a couple of examples. But obviously, target pay benchmarking is something I'm sure all of you do. How does our target comp structure compare to the peer group target pay structure? I will drop down to the third one and say, in addition to looking at target pay, it's also important to look at just pay and performance alignment. And here we're talking about actual pay instead of target pay. So first thing is our target pay structure competitive? Second thing is the actual pay that we're delivering aligned with our performance? Then I think you go back up to the second one and say, well, how do our incentive plan designs look relative to our peers in terms of if it's the short-term incentive plan, maybe it's the metrics and the weights. If it's the long-term incentive plan, maybe it's the type of equity that we're granting and the vesting schedules. And then after that, you kind of go to the fourth one and say, well, how about our equity plan dilution and grant rate? In other words, is the total potential dilution of our equity plan consistent with our industry peers? And are we granting equity at about the same pace as our industry peers? So again, we see these as pretty traditional analyses. We won't spend a lot of time on them, but if we do turn the page, just a couple of examples of, visually trying to convert data into information. The left-hand side would show you each individual job that you're benchmarking and how their pay compares to market. And then what's boxed in at the bottom would be for the team as a whole. A lot of committees we work with, they're more focused on just the team as a whole and not the individual executives, and that's fine. Right-hand side just looks at pay mix in the same type of fashion, by job and in aggregate. And then if you turn to the next page, you'll see just again an illustration of pay and performance alignment in a very simple way, which is for this company. If you looked at the right-hand side of the chart, we looked at an array of financial metrics. The number that you see is what percentile they were positioned at. And then what's boxed in here for them is just a simple message that across an array of financial metrics, we think we were performing at the 64th percentile, and we were paying at the 60th. So those two numbers are close enough together to say directionally, pay and performance were aligned. So the traditional things I'm sure you're all doing. Let me turn it back over to Kim to dig into some of the more interesting analyses we do.
Yeah, so we've got on the following page just some of those non-traditional analyses, and I won't spend too much time here because we're actually going to have an example for each. So if we go to the next page, we're going to dive into incentive plan payout history. So we do have a traditional rule of thumb, and I want to just clarify here. So what we typically see in terms of payouts is that, your plans pay out at least at threshold 80 to 90% of the time. So that means 10 to 20% of the time, there's zero, no payout at all. Target 50 to 60%, and then maximum 10 to 20% of the time. So if you think about that normal distribution curve, at the tail ends, you've got your no payout and your maximum payouts. And then in between, you've got your around target payouts. Now, that's just been a traditional rule of thumb, but what you can do is look at your peer payout history compared to yours to see, well, have there been any market anomalies that are changing this rule of thumb? Is it just us, or are peers experiencing something similar? So in this example, you can see that red line, the company has had some high payout years. So 4 of the 5 are above target, but that doesn't seem unreasonable when we look at the peer data. So you can see how that plays with the median, that blue line as well. Overall, the peers are really performing well over this 5-year history, and most have paid at, if not above target during that time frame. So this is interesting because it adds just some additional context to a question of, well, are our incentive plans paying out high too often or low too often? It just adds a little bit of market context here. On our next page, we'll jump into incentive plan slopes. So this is an interesting concept, especially if your payout history isn't falling in line with how you would expect. So this gives you an opportunity. We've got both visually with the graphic above and some numbers for you numbers folks in the table below. You can see how pay and performance ranges kind of play with one another. So the range does impact the opportunities here. You can see if we follow this one example where we've got the blue for the client here, we've got an entry performance at 90% of target for a 0 payout, and then it starts. That's right where they hit, the entry point for their incentive programs. Versus peers at 85% of target, they start paying 50%, which is interesting. So a lower threshold starts those incentive program payments. Now, if we look on the other side toward maximum or those stretch goals, the company here has a little bit narrower. They've got a steep curve here. So at 200% payout, they require 110% of performance versus median, which requires 115% of performance. Taking a step back here, one way to kind of combat some unknown uncertainty in the incentive program is to kind of flatten your line, make that entry point into the payouts a little bit easier to achieve, but also making those maximum amounts a little bit more challenging. So this is interesting context around threshold and maximum levels when really there isn't much to begin with. So peers do add some color here.
A lot of attention being focused on slopes, having gone through COVID, how steep they should be, how flat they should be, how uncertain is our business. Generally, the more uncertain the business environment, the flatter these payout curves tend to be. But we've seen a lot of companies that have moved to this concept of a strike zone on their payout curve, meaning that there's a flat part of the curve around target. It's not just a straight line. And for companies that have some uncertainty about where to put the budget or where to put the goal, that strike zone can make a lot of sense. It just says, hey, if we're plus or minus 2 or 3% of our budget, it's just 100% payout. There's no more to be gotten for being a little bit above, and there's no takeaway if you're a little bit below. So if you're one of these companies that really faces, goal setting uncertainty, I think a strike zone or something like that is an interesting thing to consider here.
All right, if we move to the next one, let's just see. So how do our plans actually, or how are they paying? Are they paying out as we would expect? This is somewhat traditional. in the sense of pay and performance alignment, but the non-traditional aspect is this realizable pay scenario where realizable, we're looking at that opportunity, the actual pay here. We've split it out and shown two different examples. So one is where we focus just on LTI programs. So LTI, that's going to take into consideration stock price changes. It's going to take into consideration your PSU programs, so how those performance programs are actually paying out. Here we've got at the top, we've got some performance criteria. So this might be specific for your plan design, those key metrics. We've got a composite performance. So overall, looking at those three measures, they're falling at the 55th percentile. When we look at realizable pay, we're splitting it out. We're showing CEO and other NEOs. You can see they're around the, just with performance, 50th for CEO and 55th for other NEOs. So realizable LTI opportunity is aligned with that long-term, the 3-year performance percentile rank there. Pay performance alignment. And of course, you might be more familiar with that chart on the right-hand side where we really have that pay for performance alignment chart where we've got the different quadrants. That top quadrant, high pay, low performance, you want to be careful about that. That bottom quadrant, low pay, high performance, again, another danger zone. If you fall on that pay and performance corridor, that's the ideal. And we've kind of circled this company as falling right in that top quadrant, high pay, high performance, and alignment. So this is a good way to test your program. Are you actually getting the desired results from it?
What's funny, Kim, is as you know, a lot of times when we plot these companies, someone on the comp committee will take a look at maybe somebody who's in one of those danger zones. It's like, I knew it. I knew that company was overpaying for the level of performance, that they've delivered. And it can be very confirming, that we don't need to chase every company's pay practices because, maybe they are doing something that has become over time a little bit misaligned with the performance. So it's fun to not only see where you end up, but with where all your competitors end up on an analysis like that.
Exactly. And it adds another dimension to your traditional target pay analysis. This now takes it another step as to, well, how are those programs actually paying out? So it's an interesting second step there. Now we've got one more non-traditional example here. So this is really assessing your goal setting rigor. And I know we've had a lot, you're going through COVID, even to today's times. How challenging are our goals? Are we sufficiently challenging? Are we too difficult? So here we've shown two different kind of looks at it. So you can compare your goal structure to your prior year targets or actuals. And that's what this top chart is trying to get at here. I do want to call out this is a growth. So what you'll see for the peer 50th percentile, what we're saying here is their target goal has increased 26% over last year. The company has increased 35% over last year. So what we're saying here is compared to prior year targets, the company has a more challenging or a higher level of performance for their target required than peer 50th. Just kind of adding an element for the targets, just a comparison point. And then of course for threshold and target as well. And then that bottom chart, this is just another way to kind of assess those absolute goals. So you lay those goals, your target, your proposed threshold and maximum on top of peer performance. So same metric across the board. How have you performed? How have peers performed? And where is your goal set structure kind of laying on that? Although you might be setting a target that is lower than your actual last year, how does that compare to consensus estimates? In this example, the target is lower than last year's performance, but you can see off to that right-hand side, that red line is above where they expect or the consensus estimate is for the company. So they're a little bit more aggressive. And their proposed maximum is also well above the 75th percentile. Threshold is above the 25th percentile of peers. So it gives some context for an otherwise unknown area. You feel like you might be making these goal levels in kind of a vacuum. This just adds some market context.
And I know we need to get to Q&A, but again, if you can see what we're doing here, if you're a company that maybe your payouts have been 200% of target for 3 years, and you're saying, gosh, have we earned it? We're trying to show you some analyses that would say, well, let's look at our relative performance. Yes, we have outperformed. Let's look at our slopes. Is it easier for us to get to a maximum payout than our peers? No, our slope is aligned. Have we been setting easier goals than our peers? In this case, no, right? This company was setting its targets 33% ahead of, last year's target, whereas the peer median was only 26. So there's lots of ways to try to use some of these analyses to just make sure that nothing's broken in the pay-performance relationship at your company.
And we do have one last poll question. Maybe we can run this one quickly. So now that we've gone through all 4, which of these non-traditional analyses is most interesting? The incentive plan payout history, incentive plan slopes, realizable pay versus performance, or the goal setting rigor analysis? Now that I'm reading this out loud, I feel like we should have had an all the above option.
So true. Yeah. Let's see. If I had to predict on this one, I'm going to say C might win the day. That's always a crowd pleaser, although the incentive plan slopes is so critical in today's world.
It is interesting. And I think it kind of goes to, well, what have you been challenged with lately? Are you worried? And I think the go-to is, well, are our programs actually paying how we planned and how we wanted them to? So I think realizable pay and performance gives you that big picture answer.
And again, these aren't just analyses to do for the sake of doing analyses. They're trying to answer questions, So again, it's a way to use data to help you make better decisions or assess what you have going on.
Mm-hmm. And the results are in, and actually realizable pay versus performance did win out, but by 34%. Goal setting rigor analysis, 30%. So those are very close.
Yeah. Excellent. That's fantastic.
Now, I think with this, we have a few more, but wait, there's more, and we can just touch on this very quickly. So CEO pay ratio analysis, this is really, it's more than just the ratio. Take a look at your actual median employee pay. How does that compare to the peers as well? It adds an additional layer to the ratio. Actual total cost or spend for your top 5 as a percent of EBITDA. Again, just informing how much is your spend compared to your profitability. And then the last item, this could be really any sort of a benefit, a perquisite. We have disclosures available. There is data. So if you are offering a perquisite, such as security benefits, how common is it? And if it is offered, what sort of a value are you providing? Is it an allowance? And you can get into more details around that design. So just some additional perspective that you can get from your peers.
You're so giving. There's always more, Kim. There's always more.
I forgot there was more.
The quick summary for you all, and we hope to get to a couple of questions, is, again, you have to be thoughtful about how you build peer groups, and it's really our last, slide, kind of closing thoughts. You have to be careful about how you pick the companies, and you have to be careful about the resulting group. There's no perfect peer group, as I'm sure many of you on the phone or on the video today know. But the last is really that there's lots of ways to use peer group data to inform your decision making beyond, the traditional analyses that you're all familiar with. So with that, we'll see if we had any questions pop up during the session. But as Mary said at the beginning, we'll be willing and able to respond to all of your questions offline as needed.
Yep. Great. Thank you so much, Greg and Kim, for your expertise. We really appreciate that you are bringing this to us. We do have time for maybe a question before I have to kind of give some final announcements. So the one that I thought was really valuable, what do you recommend for companies that are not publicly traded and whose peers are likewise not publicly traded? So those private companies.
Yeah, there's a couple of things that come to mind. And there's all different kinds of private companies. There's family-owned businesses. There's companies that are owned by private equity. There's companies that might go public at some point. There's ones that are going to forever stay private. So it's a tough question to answer overall. But What we say is first focus on who you're competing with for talent. And there's lots of private companies, especially of larger scope, that are competing with public companies for executive talent. If that's the case, you have to sort of understand that public market practice, but you also have to adjust what you do or how you compete against that market as a private company. Because you don't have a liquid equity-based currency, sometimes you have to do a little bit more with cash compensation. Sometimes you have to put in a long-term incentive plan that's cash-based. The economics are very different between paying cash and using equity. So being smart about how you use market data as a private company is an important consideration.
Thanks so much, Greg. I really appreciate that. So I know we've run out of time. For those of you who submitted some amazing questions, we're going to have Greg and Kim and the Pearl Meyer team reach out to you via email to respond to those. I'd like to take a little bit of time to thank you guys and remind our all of our attendees to please go ahead and fill out that evaluation form, whether it's in the attendee hub or in the email that comes in afterwards. I'd also like to remind you to keep an eye on our next compensation series webinar. It's going to be taking place on July 23rd at 2 p.m. Eastern time. Just keep an eye on our webpage. You'll see that it comes up either as compensation committee webinar or once we've titled it, we add the title there. You can find this webinar and the series and any of our past webinar series, both like I mentioned on NACD's page or Pearl Meyer's page. And then we look forward to seeing you next time. We'll see you on July 23rd. Thank you, Greg. Thank you, Kim. We appreciate all the expertise you bring to our members.
Thank you.
Thank you.